I want you to picture something real, not a hypothetical, not a classroom example. A real kitchen table in suburban America on a Tuesday afternoon. Her name is Linda. She is 68 years old. The casseroles from the neighbors are still in the freezer, untouched. Her husband of 46 years died 9 weeks ago. Heart attack on a Saturday morning while he was changing the oil in the garage. She was inside making coffee. By the time she heard the sound, it was already over. Now she is sitting at that kitchen table with reading glasses on, a yellow legal pad, a stack of unopened mail, and a letter from her CPA that she has read 4 times. She cannot process what it says, because what her accountant is telling her in careful professional language is that the federal government of the United States is about to reach across that kitchen table and take approximately $73,000 out of her retirement savings this year alone. Not because she made more money, not because she did anything wrong, not because she inherited a windfall or sold a business, because her husband died. That is the entire reason. The IRS has a mechanism built directly into the tax code that activates the moment one spouse passes away and begins extracting wealth from the surviving partner at a rate most middle-class American couples never see coming and almost never survive financially intact. Linda and her husband did everything right. They paid off the house. They funded the retirement accounts for decades. They never carried credit card debt. They drove their cars until the maintenance cost exceeded the car's value. Their tax bill last year was around $18,000 on combined income of over $116,000. This year, her income actually dropped by over $30,000 because she lost one Social Security check when her husband died. She is poorer than she was last year. She is grieving. She is alone. And her tax bill just quadrupled. That is the widow's penalty. And if you are married right now with a traditional IRA, a 401k, or any meaningful balance in a pre-tax retirement account, what I am about to walk you through on the Digital Defender is the most important financial information you will encounter this decade. Nobody at your brokerage is telling you this. Nobody at your bank is telling you this. Your financial planner with the framed certificate on the wall is almost certainly not telling you this. And the IRS is deliberately counting on the fact that you will not find out until it is too late to act. Before we go 1 second further, hit the like button right now. Not as a favor, as an act of defiance. Because this kind of senior financial truth content gets suppressed in 2026. Every like pushes this into the feed of one more married couple who still has time to fix this problem before the funeral makes it unfixable. Subscribe and hit the notification bell. Share this with one married couple you care about before this video ends. The math we are about to do together will show you exactly why that share could be worth 6 figures to them. Now let me walk you through what actually happened to Linda number by number so the scale of this becomes completely undeniable. In the year before her husband died, they filed married filing jointly. Combined Social Security was $60,000 per year. He had a small pension paying $18,000 annually. They had a traditional IRA with a balance of $740,000, mostly his old 401k rollover, generating a required minimum distribution of approximately $28,000. They had a taxable brokerage account generating $6,000 per year in qualified dividends, and they had certificates of deposit generating $4,400 in interest. Total gross household income as a married couple, $116,400. As a married filing jointly couple, they received a standard deduction of approximately $30,000. Both over 65, they received additional deductions worth roughly $9,000 combined. Their taxable income dropped to approximately $77,000. The 12% bracket for a married couple stretches all the way to roughly $97,000 of taxable income. Their total federal tax bill landed around $8,400 on $116,000 of gross income, an effective rate of about 7%. Then her husband dies in January of 2026. Linda is now a single filer for the entire tax year. The IRS uses your filing status as of December 31st. There is a grace period called qualifying surviving spouse status, but it only applies if you have a dependent child living with you. Linda's children are in their 40s with their own homes. Linda gets 0 grace period. She files single in 2026. She loses his Social Security check entirely. Household Social Security drops from $60,000 to $37,200. His pension had a 50% survivor benefit, so the $18,000 becomes $9,000. The traditional IRA still generates an RMD of approximately $27,500. The brokerage still generates $6,000 in dividends. The CDs still pay $4,400. Linda's gross income is now $84,100. She lost $32,000 of household income. She is significantly poorer. Now watch what happens to her taxes. As a single filer, her standard deduction is cut roughly in half to approximately $15,750. Her taxable income comes out to approximately $60,350. The 12% bracket for a single filer ends at roughly $48,475. Linda has crossed into the 22% bracket. She is paying 22 cents on every dollar above that line. But that is only the first blade. Her provisional income is now high enough that 85% of her Social Security becomes taxable, and the IRS calculates this far more aggressively for a single filer. The threshold where Social Security starts becoming taxable for a single filer is $25,000. For a married couple, it is $32,000. The IRS built a smaller shield for widows. The Social Security that was partially protected is now fully exposed. And then IRMA hits. The income-related monthly adjustment amount is the Medicare premium surcharge most people have never heard of until the letter arrives. While her husband was alive, their joint income kept them under the IRMA threshold. After he dies, Linda is measured against the single filer threshold, which is dramatically lower. Her Medicare Part B premium jumps from approximately $185 a month to around $260 a month. Her Part D drug coverage gets hit with an additional surcharge. That is roughly $900 per year. Every year. Recurring. Because she had the misfortune of being widowed. Layer the federal income tax increase. Layer the Social Security inclusion penalty. Layer the IRMAA surcharge. Layer the loss of his income. The woman sitting at a 7% effective tax rate last year is now paying roughly 4 times the tax on less money. That is not a glitch. That is not bad luck. That is the federal tax code working exactly as it was written. Stop right here. Go to the comments right now and tell me honestly. Have you and your spouse ever sat down and run this calculation? Have you ever modeled what your tax bill looks like the year after one of you dies? Tell me your ages, roughly what is in the traditional IRA, and what your pension survivor benefit looks like. We are going to work through the exposure together in the comments. I read every single one on the Digital Defender. Now let me show you the 3 mechanical traps because Linda's story is only the surface. Most financial professionals only address the first trap. They miss the second. They almost universally miss the third. And the third one quietly bleeds the surviving spouse for the rest of her life. The first trap is the bracket collapse. The 2026 single filer bracket structure is roughly half the width of the married filing jointly brackets at almost every income level. The 22% bracket for a married couple spans approximately $110,000 of taxable income. For a single filer, that same bracket spans approximately $55,000, half as wide. The entire architecture of the tax code is built for 2-income households, and the moment one person dies, the survivor falls through a trapdoor with no warning and no net. The second trap is the RMD crossfire. This catches people who believe they can simply spend less and avoid the tax. They cannot. The required minimum distribution does not care what you spend. It does not care that you are grieving. It forces a specific percentage of your traditional IRA balance out of the account every single year based on the IRS Uniform Lifetime Table. By age 80, you are pulling close to 5% of the entire balance annually. By age 85, it approaches 7%. The IRS forces the income out, and that forced income in the narrower single-filer brackets gets taxed at rates that would have been impossible for a married couple at the same income level. Forced withdrawals plus narrowed brackets equals systematic confiscation. The third trap is the IRMAA spike, and most people only learn about this layer after it has already cost them. IRMAA operates on a 2-year look-back. Your 2026 income determines your 2028 Medicare premiums. So if you do something in 2026 that spikes your modified adjusted gross income, like finally beginning Roth conversions after your CPA wakes up to the problem, you just triggered a Medicare premium increase that will not appear on your bank statement for 24 months. The system is specifically engineered with this delay so you cannot connect cause to effect. By the time the higher premium hits, you have forgotten what income event triggered it. That is not an accident in the design. That is the design. 3 traps, stacked, fired sequentially. The bracket collapse hits the year of death. The RMD crossfire hits every January for the rest of the surviving spouse's life. The IRMAA spike hits 24 months after every income event. There is no escape once the funeral is over. There is only escape before. The Joint Committee on Taxation has been aware of the widow's penalty since the 1980s. Think tank reports from across the political spectrum have documented it for 4 decades. Every Congress that has had the opportunity to correct it has chosen not to. Why? Because the widow's penalty generates billions of dollars in incremental federal revenue annually. There are approximately 800,000 new widows and widowers in the United States every year. The average widow over 65 carries a traditional IRA balance somewhere between $250,000 and $1.5 million. The marginal tax rate jump from the bracket collapse alone, multiplied across that population, is an enormous revenue stream. The government calls it revenue. You and I should call it what it actually is. Send this video to a married couple you care about. Right now, today, one couple. The math we just did with Linda shows the cost of inaction is 6 figures. The cost of a 30-minute conversation tonight is 0. Now the strategy. The 4 assets that create the most exposure and exactly what to do about each one. The first and most important asset is any traditional IRA, 401k, SEP IRA, or pre-tax retirement account. Every dollar in a traditional pre-tax account is a dollar of future ordinary income the IRS has not collected yet. They are letting it grow because they get to apply a higher rate to a larger pile the moment the bracket collapse activates. The fix is Roth conversions. Aggressive multi-year, strategically planned Roth conversions executed while both spouses are still alive and married filing jointly. While married and filing jointly, you can fill the 22% bracket all the way to approximately $206,700 of taxable income. You can convert $100,000 from traditional to Roth in a single year, pay the tax now at 22%, and that money becomes permanently tax-free. No required minimum distributions, no tax on growth, no tax on qualified withdrawals. And when one spouse dies, the surviving spouse inherits a Roth IRA that generates 0 taxable income and 0 IRMAA exposure from withdrawals. If you have $800,000 in a traditional IRA at age 68 and do nothing, your surviving spouse will pull between $28,000 and $50,000 out of that account every year for the rest of her life, all taxed at the single filer rate, all pushing toward the IRMA threshold. The lifetime tax cost post-widowhood is conservatively between $180,000 and $240,000. If instead you convert over 6 to 7 years within the 22% and 24% married brackets, the total tax paid is roughly the same, but the Roth then grows tax-free and the surviving spouse withdraws tax-free. You convert a recurring lifetime liability into a one-time payment, and you execute it in the wider brackets that disappear the moment the funeral home leaves your driveway. The second asset is the taxable brokerage account. Most advisors get this exactly wrong. The instinct is to gift appreciated stock during your lifetime to reduce the estate. For a married couple, where one spouse may predecease the other, that instinct is expensive. The correct strategy is built around Internal Revenue Code Section 1014, the step-up in basis. When a spouse dies and leaves appreciated assets to the survivor, the cost basis resets to the fair market value on the date of death. All embedded capital gain is forgiven. An index fund purchased for $100,000 in 2005 and worth $240,000 at death transfers to the surviving spouse with a fresh basis of $240,000. She can sell it the following week and owe 0 in capital gains tax. But this only works if the account is titled correctly at death. In a joint tenancy account in a non-community property state, only 50% of the account receives the step-up. If you live in a community property state, California, Texas, Arizona, Washington, among others, you receive a 100% step-up on jointly held community property. Most other states, including Florida, Ohio, and New York, are non-community property states. Speak with an estate planning attorney about correct titling before it is too late to change it. The wrong titling costs the surviving spouse tens of thousands in unnecessary capital gains tax. The third asset is the unprotected pension. Most pensions default to a single life annuity unless the retiring spouse affirmatively elects a joint and survivor option. The single life option pays a higher monthly check while the retiree is alive and pays nothing after death. The joint and survivor option pays less monthly, but continues paying to the surviving spouse for the rest of her life. Federal law requires the non-retiring spouse to sign a notarized waiver to elect single life. Most people sign that waiver without fully modeling what the surviving spouse's income looks like if the pension disappears. If you are pre-retirement, elect the highest survivor percentage you can reasonably afford. If you are already retired and locked into single life, you can build a replacement through a permanent life insurance policy on the pensioner, sized to replace the lost income stream. The death benefit under Internal Revenue Code Section 101A is income tax-free. The surviving spouse uses it to fund replacement income with no bracket collapse exposure and no IRMAA spike. Save this video right now. Bookmark it, because when the letter arrives and the CPA calls with numbers that do not make sense, you are not going to remember the specific strategies covered here. You will need to come back to this. This is the Digital Defender's Survival Manual for Surviving Spouses. The fourth asset is the CD portfolio, the money market account, and the taxable bond portfolio. Most retirement households carry between $50,000 and $300,000 in certificates of deposit or treasury bonds, generating fully taxable ordinary income every year. While both spouses are alive, that interest sits comfortably in the wide married brackets. The day one spouse dies, that same interest gets pushed into the narrower single filer brackets and may push the survivor across an IRMAA tier she has never encountered before. 3 fixes. Replace high-yield CDs with high-quality municipal bonds from your home state. Interest from in-state municipal bonds is federally tax-exempt under Internal Revenue Code Section 103. It still counts toward the Social Security inclusion calculation, but it eliminates the federal income tax line entirely. Alternatively, shift the cash into a multi-year guaranteed annuity, which compounds tax-deferred and does not generate a 1099 each year. Or use a properly structured cash value life insurance policy where growth is tax-deferred, withdrawals up to basis are tax-free, and the death benefit is income tax-free. Which option serves you best depends on your state. California residents facing high state income tax will find municipal bonds extraordinarily powerful. Florida residents with no state income tax will find the annuity or insurance approach more compelling. Now look at what you have accomplished if you execute all 4 moves while both spouses are still alive. The traditional IRA converted to Roth over several years in the wider married brackets. The surviving spouse inherits a tax-free account with no RMDs and no IRMAA exposure. The brokerage titled correctly. The surviving spouse receives a full step-up in basis and sells appreciated positions with 0 capital gains tax. The pension elected as joint and survivor or replaced with a life insurance death benefit. The surviving spouse receives tax-free replacement income. The CD portfolio restructured into munis, a tax-deferred annuity, or insurance products. The recurring taxable interest removed from the single filer bracket calculation. Linda, in our example, instead of facing a $73,000 tax bill plus IRMA surcharges on less income, would be paying approximately $8,000. Same gross income, different account structure, $65,000 per year recovered. Over a 20-year survival period, that is $1.3 million of generational wealth staying in the family. The window to act is narrower than you think. Roth conversions ideally take 5 to 7 years of phased execution. Pension elections are locked the moment you begin drawing. Life insurance underwriting requires both spouses to be in reasonably good health. If one of you is already in declining health, half of these tools are already off the table. If you wait until the diagnosis comes, you have already lost access to the most powerful options. The IRS is patient. The IRS is counting on you to wait. Tonight, sit down with your spouse. Write down 4 lines. Traditional IRA or 401k balance. Taxable brokerage account balance and how it is titled. Pension election status. CD and bond portfolio, total and annual interest generated. That is step 1. Step 2 is finding a fee-only fiduciary advisor or estate planning attorney who understands the widow's penalty specifically. Bring the notebook, run the math, build the plan while both of you are still at that table together. If this investigation on the Digital Defender saved you money, scared you into action, or made you furious on behalf of the 800,000 people who fall into this trap every year, hit the like button, subscribe with the bell on, and share this with one married couple you love before you close this video. One couple. Today, not tomorrow. The IRS is patient. The trap is set. The math is done. The only question is whether you act while both of you are still sitting at that kitchen table together. The tools exist. The escape routes are written into the same tax code that contains the trap. You just have to find them before the funeral makes finding them irrelevant. I will see you in the next investigation on the Digital Defender. Stay informed, stay protected, and move those 4 assets before the IRS gets the opportunity to move them for you.